So today, to finish up this month-long series on bond investing, we're going to do something I love. We're going to talk about what bond gadgets that could help stop rising rates from killing your assets. Oh, I love gadgets. Gadgets, toys. Tech toys are my favorite. What are yours? Welcome to the Retirement Answer Man Show. I am your host, Roger Whitney. If you're new here, no, we don't want you to just survive retirement. We want you to rock retirement. Oh, gadgets are great. And we know James Bond, every James Bond movie has Q, who creates some amazing gadgets. You have the ski pole rocket launcher from The Spy Who Loved Me. The grenade launcher pen, a pen that launches a little grenade from Never Say Never. The Omega Seamaster laser watch from GoldenEye. And actually, one of my favorites is Odd Job, his bowler hat that he could just flick and cut pieces of wood in half. Pretty cool. Now, in bond investing, if we're worried about tackling this villain of rising interest rates, it's very easy to get attracted to the gadgets that the investment industry creates to try to kill that villain. I got an email the other day, as an example, out of the blue. The gentleman said, "Hey, Roger, I've emailed you in the past, and I wanted to circle back with an idea for you." I get these kind of emails all the time. He says, first quarter of 2018 was the only time in the past 20 years that both the S&P 500 index, the stock index, the Barclays aggregate index, the bond index, finished with negative returns. And then he concludes with, "I think now is a perfect time to think about non-correlated assets, alternative investments." In this pitch, this email about this gadget, he says, "Hey man, we're targeting 12 to 15% returns with this cool gadget. We want to have about 7% cash flow. Give me a call. Let me tell you about my gadget." Okay, he didn't say it quite that way at the end, but you get the gist. Q's gadgets in the Bond movies were always subtle, right? You got the cool Seamaster on your wrist, and he pulls it out just at the right time to zap somebody or to cut out of his handcuffs to get free. So the question is, how subtle do we want our bond investing gadgets to be? Do we want to be like James Bond and just pull it out at the right time, use it when we need it, but then put it away knowing that it's really Bond who gets the mission accomplished? Or do we want to be like Iron Man in this gadgety suit that really, how much human interaction and control is there in it? We're going to have to make a decision on how subtle we want to be with our gadgets or how Iron Man-ish we want to be. So to think about the gadgets, we need to decide, are we trying to be subtle or are we going big with these suckers? It's an important question to answer, which we're going to try to address on this show. So in the Hot Topic segment, we're going to talk about what is the mission that Bond is on in an investment sense anyway. Let's define the mission that we're on when we're investing in bonds. And then in the practical planning segment, we're going to talk about some gadgets and some possibilities, but also some pitfalls of putting these in your arsenal. But we can't do any of that until we have that, all important disclaimer. Obviously, we're talking about investing, and we're going to talk about indexes like the S&P 500 and Lehman Aggregate Bond Index. Remember, you can't invest in those indexes. They're just models. You can only invest in things that try to mimic them. When we talk about performance, it's all in the past, and they have no guarantee of future results. And different types of investments have different types of risks, so make sure you're prudent about that. And before you make any decisions, talk to your legal advisor, your tax advisor, or your financial advisor, because that's just common sense. This is all about helpful hints and education. Don't take advice from me unless you're a client. So in the Hot Topic segment today, what I want to do is talk about what mission are we on when it comes to investing and figure out the role that bond investing plays in that mission. And then we'll get into the gadgets within the role of fixed income or bonds. Here's the problem with gadgets. Just to back up a second. Gadgets tend to be what enamor us, what attract our interest. And it's very easy to get too gadgeted up, if that's a phrase. For example, just a week or so ago, I started the Retirement Answer Man YouTube channel. It's a show called Roger That, where we're answering questions and talking about news in the day and giving reviews of things that you can use to create a great life in retirement. And when I was setting up the, I guess we'll call it studio, where I was going to film these videos for YouTube, I got enamored with the gadgets. I enjoy tech gadgets, especially. I bought cameras, I bought lights, I got microphones, we hung wood on the wall so I could have a backdrop. I got enamored with that, and it's easy to go down a rabbit hole and spend a lot of money. And we got to be careful when we get into gadgets, when we get into investing. So we need to establish what is the true mission of investing in bonds. What is it trying to accomplish? Because that will give us a much better framework to make sure we don't get too gadgety in our execution on that. So let's say you're 55 years old, and we'll say you have a 40-year timeline. There are two big boogeymen, villains, that we have to deal with in order to accomplish the mission of having a great life in quote-unquote retirement, right? Number one is we have to keep up with inflation, right? Because we're dealing with a long timeline here. And inflation, if we're not careful, will eat our lunch and slowly zap the purchasing power or lifestyle as prices increase over time. So as an example, inflation's this silent enemy. Since 1970, CPI, the Consumer Price Index, has averaged about 4%. So we'll use that as the proxy for inflation. But if we get even more specific, if we look at 1970, a loaf of bread cost 25 cents. A gallon of gas was 36 cents. Do you know how much a brand new car cost you in 1970? About $3,500. Brand new. So we know all those things cost a lot more today. Gas and bread is, $3, $4, depending on where you live. A new car isn't $3,500. It's like $30,000 on average, right around there. So one villain we got to tackle is inflation. The second villain that we're going to have to deal with in retirement, or as we get closer to it, is volatility. We got to deal with volatility because we've spent decades accumulating the wealth that you've accumulated. Now you're wanting to create a life of more freedom, and you want to unleash that from your assets. Well, if you've already created the wealth, sure, creating more wealth through prudent investing is great, or working towards that. But once you have the wealth, a big villain that you need to tackle, or manage is probably a better way to say it, is the volatility, the chance of losing that money because you were too aggressive in how you were investing. So one villain we got to deal with is inflation. The second villain we got to deal with is volatility. So let's think about bonds on these dual missions of dealing with inflation and managing volatility. Well, first off, bonds suck at fighting inflation. It's like taking, a spork when you're fighting Godzilla. It just ain't going to work. Bonds are horrible at fighting inflation. So it's not a great gadget for that, that's for sure. But they do pretty well in fighting volatility. So as an example, the measure of volatility is something called standard deviation, which is how much returns vary around the normal average return that people might expect. And bonds has a standard deviation less than half of equities, meaning it's a lot less volatile in terms of the performance. You don't get as huge of swings on the up, but also on the down, which is the one that we care about. So they do very well at fighting volatility, but they're horrible about fighting inflation. And part of the fear right now is that with fixed income or bonds, in a rising interest rate environment, that, hey, they might get a little bit more volatile than they've been because we're changing, it seems, the interest rate cycle of, remember we talked about lowering interest rates really helps bond investors. From a price perspective, it's been a beautiful era of 30, 40, 50 years to be invested in bonds from that aspect. Well, if we're changing and we're going to go in this rising interest rate environment, now it's like a headwind blowing at you, which could make bonds more volatile. Well, we already know it sucks fighting inflation, the first villain. Now it might not be that great potentially at fighting volatility. Now, last week we heard that, well, maybe it's not as bad as we think it is, which I would tend to agree to. So now we need to think. Now we're all sort of worried about that. So that's why I, as an advisor, get tons of emails of, hey, I know you might be worried about this. I got this cool gadget. Let's take a look at it. It might solve your itch. And you, as an investor, are probably getting similar types of things when you try to tackle this problem. So I wanted to set that stage. Now let's get into the practical planning and talk about how do we, one, evaluate a gadget, and two, just highlight some of the more common gadgets in our fixed income arsenal that we might be able to pull out so we can zap the villains that we're worried about on this mission we're on of creating a great life. All right, we're ready to talk about gadgets. I'm so excited. Okay, calm down, Roger. Okay, when we're talking about gadgets, when we're looking at them, it's easy to waste a lot of money. I mentioned that before. So we can buy unproven but cool things, right? What this guy emailed me is probably those one unproven but cool things. And it's interesting from an investment standpoint when you're evaluating investment strategies. It's very easy to see things and not appreciate enough how unproven they are. Because when you think about it, whether we're evaluating an investment manager or an alternative investment or a real estate deal, doesn't matter what it is, every proposal that you get in front of you is always going to look awesome, right? Because the marketer, the one proposing it, is the one creating it. So that frames the conversation, and it's easy to get caught into what the numbers look like in the proposal, like this email this guy sent me, and assume that, we're targeting that, so that just means they're probably going to hit it, and take those numbers for granted. When the real issue, when we're evaluating a gadget, is can it actually deliver on the promise? Because if we're purchasing a gadget, whether it's a camera, a alternative investment, a bond alternative investment deal, all we care about is repeatability of what they did in the past or what the promise is that they say they can do. We basically are trying to understand, can they actually deliver on what they're telling us or on what they've done in the past? Just because they've done it in the past doesn't mean that it's going to happen in the future. There are a lot of things, so you have to go through a due diligence process to gauge the level of repeatability. Now, when it comes to gadgets, most of us don't do that. My humble opinion, most advisors don't do that in as deep and intentional a way as they probably should, because it's hard work and it gets into a lot of gray areas to evaluate the potential of repeatability. And it's easy just to hit the easy button. Just, okay, they say they're going to do this. They seem like super smart people. Let's try it. That's a horrible way to allocate money, whether you're buying a camera or you're buying a bond gadget. So we got to be careful there. The second thing that we need to watch out for in wasting money is, okay, are we buying more than we need? Do we really need to look like Iron Man, or do we just need to have a rocket launcher pen that we pull out every now and then? Very easy to spend money on lots of things you don't need. That's a little bit of my advice in the tech area that I got to be careful of. And then lastly, it's easy to hop from gadget to gadget. That one didn't work, but I'll buy that one. We just go from strategy to strategy. So these are some of the pitfalls that can cost us, waste a lot of money, make it a lot more complicated, and really make it much more frustrating, which can lead to bad behaviors. You can see how complicated this is, right? Okay, I know I sound like an old curmudgeon. Let's talk about some of these cool gadgets you want to get to. The first is the very simple one, which John in our interview talked about last week, which is managing duration and maturity. The first gadget is, if we're in a rising interest rate environment, to minimize the volatility end of the spectrum, if we lower our maturities, meaning how long the bonds are before they mature, that will decrease the volatility of a portfolio. And we've seen many people doing that for years now, of going into low duration investments to try to minimize the volatility. And again, refresh, the lower the duration or the maturity of the bond or the portfolio that you're going into, in theory, and it plays out fairly well, the less volatile it will be to interest rate increases. The reason for that is because the maturity is so short, the money will mature and be able to get reinvested quicker, which means that you'll catch up with your rising interest rates. Whereas if you buy a 30-year bond or portfolio that has that kind of maturity, you got to wait 30 years to get your money back to be able to reinvest. So that's a lot more risky. So one simple gadget, very subtle, is just to shorten the maturity levels of your bond portfolios to try to minimize the volatility aspect of it. The second gadget, which I'm actually a big fan of, is foreign bonds. U.S. Treasuries, corporate bonds in the U.S., U.S. municipals, they're great. They have their role in a portfolio, but there's a whole world out there. It's sort of the same logic of investing in international stocks, right? Not just U.S. stocks. There's a whole world of companies and governments out there. So why don't we open it up? Now, I tend to be a global investor when I'm allocating assets for clients, in that why would you limit yourself to certain things? Now, foreign bonds, one of the attractiveness to that gadget for many is, hey, normally all economies are not in sync together, right? When one is going into recession, one is growing, and they're at different cycles. So by having a portion of your bond portfolio in different economies that are in different parts of the interest rate cycle or economic cycle, you get a little bit more diversity there. And historically, that does prove out. It makes it a little bit more complicated because now you have currency, the value of the dollar relative to a currency in another country. But I do think that this is a gadget that needs to be or could be a part of everyone's portfolio if done right. Again, it's got to be subtle. We'll get to where I've come to on a lot of this, but I think foreign bonds and international bonds have a good place in a portfolio as a gadget to help you accomplish where you want to get to. The third gadget makes things a little bit more complicated, and that is buying individual bonds rather than a portfolio that holds a lot of bonds. If you buy individual bonds, you're going to have a bond that has a set maturity. So as long as you hold it to maturity and they're true on their promise, you get all your money back. So the price fluctuations while you're holding it shouldn't make that big a difference. It would only impact you if you had to sell. Whereas in a portfolio, they're constantly trading bonds, and a portfolio never actually matures. So the value of the portfolio when you go to sell it, it's always going to be fluctuating. You're never just going to get your money back. So there's some value potentially in a gadget of buying individual bonds. The issue is, or could be, that now you have to, well, what do you buy, right? Buying bonds is a whole nother ballywick that you got to get into of, I need to diversify from the types of bonds, the sectors of bonds, the geographical and industrial location of bonds. It can be this whole ball of wax that's just more complicated than almost everybody wants or needs to get into. It really complicates the situation. Now, Nancy asked about, I guess Guggenheim has these shares where they buy a portfolio of bonds that mature at a specific date and then actually liquidate and pay out to everyone. And I imagine there are other things that do that as well. I am not familiar with the strategies from Guggenheim, but she said she'd heard about them on some other shows. And they basically, I want bonds that mature in 2024. You buy the portfolio, and it has the portfolio, and all those bonds in that portfolio mature in the same year. And then you just clip coupons. And then when it gets to that date, it just liquidates and pays back to all the investors, I imagine. And what you get, though, is instant diversification, right? Rather than finding one bond that matures in the date that you're looking for, you get in theory, portfolio bonds that are well diversified. So it's like an easy button for maturity, and then you're going to pay for that through the expense ratio. And I haven't evaluated them, but that may be a good option to look at if this is something you're really concerned at. I have not used those or anything like that in the money that I manage with clients, but it's a viable option, Nancy. assuming that you do the due diligence on whichever strategy you go for. And where that might come into play is in the next gadget that we might be able to pull out, which is called a bond ladder. So a bond ladder is basically, if I want to have a bond portfolio, I can buy, we'll just keep it real simple here. I'll buy, let's say I have to buy 10 bonds. I'll buy 10 bonds and I'll have one that matures next year, one that matures in 2 years, in 3 years, in 4 years, in 5 years, in 6 years, and so forth. And you create a bond ladder. So what ends up happening is every year you have a bond maturing and you get the money back from that bond. And then what you do is you go out and rebuild the next rung of the ladder and so forth. And so every year you're going to have bond coming due, which you get to reinvest at the current rates. And over time, the goal is that interest rates going up or down, you're always going to have bonds that are maturing and that are longer term. So over time, you should be able to maintain the averages and manage the volatility because you're never actually selling anything. You're just buying and holding to maturity. And I think that's part of what strategies like the Guggenheim one that Nancy mentioned are trying to do is, well, you could go buy individual bonds to build this ladder, or in theory, you could buy these kind of strategies that have maturities in the rungs of the ladder that you're looking for and just build it that way. It may add some complexity, and you got to make sure the strategy is actually doing what it says it's going to do. Now, I have used a version of this in portfolios because there are funds or strategies that essentially do that internally and then try to do it a little bit more smartly in terms of how they trade and targeting maturities and dealing with calls and all that. So there are some where you don't have to buy 10 or 5, however many individual ones that will basically buy your Insta button, easy button bond ladder and actually use that kind of approach. And I have used those in the past. I think there's some value there potentially. Now, the next gadget is high yield bonds. So what is a high yield bond? Well, it's actually, it's a rebranded bond, right? We're talking about, in some ways, we talk about branding. So high yield bonds, they used to be known as junk bonds, right? So these are bonds that have lower credit rating. They're not investment grade, which is a category of bonds that everybody says are probably okay. They're below investment grade, meaning that there's some risk they might not be able to pay you back. And there are a lot of strategies or funds that invest in high yield bonds. And they, due diligence on can they pay me back is obviously much more important. The reason this is a gadget if we're trying to deal with rising interest rates is because they're quote unquote high yield, meaning they have to pay an above market interest rate to whoever owns their bonds to compensate for the risk that they might not be able to pay back. And as interest rates rise, because they have such a high coupon or they pay as much interest, they tend to be a little less volatile to interest rate movements because the cash flow is much better than normal bonds. Now, the difficulty with this kind of gadget is, one, if you're going to buy a bond on your own, well, that's a little scary. You got to do a lot of due diligence so that you feel like you're going to get your money back. And if you buy a portfolio, if the economy worsens, these kind of portfolios can really get smacked in the face because that means that iffy investment just got even iffier because their business isn't probably doing as well. So where you can really get bitten here is if we get into a period of stress when everybody's worried about business and whether they're going to get paid back, these things can be volatile all of a sudden. And we saw a lot of that 2008 period. So it's not for the faint of heart. Now, an offshoot of high yield bonds is something called floating rate bonds or floating rate strategies. So this is another gadget that I've used from time to time. Basically, it's like high yield bonds, but what they do is the strategies, usually you got to buy a strategy to do this, is it's a short-term lending mechanism where a strategy will lend directly to companies, but the maturities are like a year to 2 years. And rather than just agree on a set rate of interest or coupon that the borrower, the company will pay, what they do is they have a floating rate portion of it, meaning that every 90 days, the amount of interest that the company has to pay adjusts based on some interest rate benchmark like LIBOR or the Fed funds rate. So in theory, what happens is as interest rates increase, the amount that the company has to pay will increase along with it. And that's a buffer to managing volatility in a rising interest rate environment. So that sounds pretty cool, right? The downside to that could be that just like high yield bonds, you're really dependent on the credit research that the manager does on the company to make sure that they can actually get paid back, right? Because if they get that evaluation, if they lend to company A and company A ends up being a lot less trustworthy or able to pay back than they thought, you could have issues which affects the value of your portfolio, sometimes dramatically. Some of these went down for a variety of reasons in '08, like 30%. So you can see where this isn't necessarily quite as simple as it might seem on the front end, but they can have a place in a portfolio. Another gadget that I actually like a lot right now is if you have a 401k and it offers what is generally known as a stable value fund or a fixed fund, a cash bucket. A lot of times in 401ks, those can actually pay you fairly good interest. Right now, I think I see them when I evaluate them around 1.5%. So if you are supposed to say have 40% of your assets in bonds based on your allocation target, and you use a bond index or a fund that mimics a bond index, and it's paying 2.5, 2.6% right now, which I think is about what the Barclays aggregate pays, you could say to yourself, hey, rather than get 1% more in interest in this index-based fund, why don't I just put it into the stable value fund, get 1.5%, you miss some interest, but it is almost assured that it's not going to go down in value. And then when interest rates are in the middle or towards the tail end of their rising rate cycle, then you can reallocate. So that's not necessarily a bad idea. Now, this is where you get to how much do I want to be gadgety? In doing this, generally what I've done is say, okay, let's take 50% or 40% of what's supposed to go in fixed income and use this. I would much rather straddle the fence than go all in or all out when you're starting to use gadgets. I don't want to be Iron Man. I think it makes more sense to be subtle because we really don't, there's so much that we don't know, so we don't want to make big bets anywhere. That's part of being diversified, right? And that is really a derivative of this next strategy I'm talking about. Are we getting gadget out or what? Hopefully I'm not getting too geeky or not geeky enough. I'm guessing some of you are getting into this and some of you are like, what? That's okay. I'm going to tell you sort of where I fall here in a minute. But that strategy with the stable value fund is sort of a derivative of something called a barbell strategy, which is if you've ever been to the gym and used a barbell, right? The little one-handed thing you use curls on. It's really fat on one end and really fat on the other, but really skinny in the middle. One way to accomplish, one gadget you could use is to be heavy on your long-term equity or equity income or even some fixed income stuff on one end. And on the other end, have higher than normal levels of cash with not much in the middle and sort of get to as an aggregate to the same place. And I've seen that done just simply in a fixed income portfolio. I've seen that done adding in dividend paying companies or stocks. There's a lot of different ways you can do that. And there's actually some utility to that if you know what you're doing. So those are some of the more popular gadgets. The key for you is you got to decide where you want to be. Do you want to just simply achieve your mission with the basic tools? Nothing wrong with that if you believe it and you stick to it. Do you want to be like James Bond and have some gadgets, but be subtle about it, only pulling them out when needed and then putting them away and not relying on them for the entire mission to be achieved or not? Or do you want to be like Iron Man and go all in on the gadgets and understand what you're getting into? You're going to have to decide where you want to be on that spectrum. And if you decide to use any kind of gadget, you're going to have to make sure you have a way of evaluating how repeatable is it? Am I really getting what I'm paying for? Because just like technology gadgets, there's a lot of sizzle and sometimes there's not a lot of steak and you regret your purchase. So we got to just you have to make your decision based on your retirement mission. So let me tell you where I land on this within my practice. I use what I call a fixed and flexible approach. Okay, first off, I prefer to look at the entire balance sheet And how do we allocate the entire balance sheet, not just investment assets, to work towards the goals that someone establishes? Because investments are important, but a lot of times we have lots of other levers on our balance sheet that we need to pay attention to. Cash reserves being one of those big things in cash management. But when we get to the investment assets, I use what is called a fixed and flexible approach. We use fairly passive investments for roughly 50 to 60% of the portfolio that are, in my opinion, more thoughtfully designed than traditional indexes, but still have the advantage of very low cost, very low turnover. And then the flexible portion for the remainder of the portfolio is focused on more flexible strategies, gadgety strategies that we've done due diligence on and have confidence and are constantly reevaluating that add value given that we only deal with clients over 50, transitioning into retirement and understanding the unique nature of what they're trying to accomplish from a life perspective. So I straddle the fence a lot and I try to keep it as simple as possible. I think adding complexity is a very easy thing to do. It also complicates things much more than we really need to. So I wanted to highlight some of the strategies that we might be able to tackle this bond villain with. But the key is, in my mind, it's always about the process. You have to have a process that you follow for making the best decisions for you with the information that you have. If you can get the process right, the gadgets and those decisions end up becoming pretty easy to make. I'm tired with all this gadget talk. Let's go get Nicole on here and get happy. Hey folks, welcome to the Happy Lab where we noodle on, well, just being happy. One of the happiest people I know is Nicole. How are you, Nicole?
I am doing great.
Now, we like this bond theme. I'm loving the graphics that we're doing. Those make me happy.
It's been really fun.
But you reminded me of like the theme of this episode, the Q, the person in the background that does all this work that really makes everything that I guess pops in at those critical moments. And we have a lot of Qs, but let's talk about one Q that makes us really happy. Who is that?
So we have a super awesome podcast editor that makes us sound great every week and takes all of our shenanigans and turns it into a great final product. So
Hopefully
Michael,
yeah.
We think you're awesome.
Yeah.
And a few weeks ago, when we were recording, we actually gave a shout out to Michael and asked him some questions about himself. And he sent us an email with some pictures of his kids. And it was really fun to get to learn about him and to, take the time to learn about the people that are your Q in your life. It made him happy to hear from us, and it made us happy to learn a little about him.
Totally. And we have a lot of Qs in our life, and I bet you have a lot of Qs in your life that they're making you happy. Like I can even just think of, you can get down to the lawn person where I don't have to mow the lawn. But the point is, you build a team around you to help you get to where you want to go. And once it's working smoothly, it's easy to forget how happy they really make you. Now, let's go on and set a smart sprint.
On your marks, get set.
So in our smart sprint segment, we set a 7-day action step to take a baby step to create a great life. So 2 things I want you to do. Nicole looked at me like, I sort of messed that up, but that's okay. 2 things I want you to do or suggest that you do this week. One is look at your bond allocation and ask yourself, are you getting a little bit too tricked out in the things that you're using to implement that portion of your strategy? It's easy to take these fancy gadgets that people create and take them too far. So I want you to evaluate your portfolio for that. And then second, so we got a 2 for today, Nicole, is what we just talked about in the Happy Lab. What Q in your life can you go tap on the shoulder and thank them for helping make your life run more smoothly? I think that would be a cool thing to do too. So, Nicole, I'm a little sad that this bond theme is coming to an end.
Don't be sad. We have so many awesome things coming up.
Yeah, that's true. It's sort of fun. But I'm just going to say it. If you are looking for a cue in your life to help you complete your retirement mission, we are currently accepting clients, and we would love to set up a fit meeting to see if we're a fit. if you're in that zone and you're looking for that cue, go to rogerwhitney.com and click on Work with Roger, and let's have a conversation to see if we're a good fit to make your retirement an awesome mission. So until next week, what do we got going on next week? Wait a second. We got something really cool going on.
Something important. Don't forget.
This is by far the most popular series that we do. Dun, 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 dun. We are doing, next week, we're starting Retirement Plan Live. That is a case study where we have a listener, Sam, who is willing to share her retirement journey, and you're going to get to listen in on our conversations and ultimately see whether her retirement's going to work. Tell your friends. Shout it from the streets. Retirement Plan Live starts next week.
And especially this one is going to be different because it's a single person. So if you've got any single friends that might want to listen up.
Yeah, there are lots of quirky things that come about when you're single and retired. So we'll deal with those. Until next week, I'm Roger, the Retirement Answer Man.
We appreciate you joining us today for this episode of Retirement Answer Man. Be sure to visit rogerwhitney.com/answers to access the Retirement Answer Library with over 30 checklists to help you make the most of the only life you have. Remember, you have more power than you realize to create an amazing life starting today with Retirement Answer Man. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and no guarantee of future results. All indices are unmanaged and may not be invested into directly. Have a wonderful day.